First of all, welcome to our fourth quarter town hall meeting. Now that we're through the heavy lifting of the transition over to Raymond James, I'll be bringing back our quarterly updates calls. Larry Adam is the Chief Investment Officer of Raymond James and oversees more than $1 trillion in assets. In conjunction with his team, we're bringing you Sailing on Strange Seas today. The reason we chose this title is because we believe that we are at an inflection point in the dynamics that are driving both the economy and the financial market. Due to the length of the presentation today, I'm going to hold off on questions and answers. If you have specific questions, please feel free to send me an email or give me a call. Let's go ahead and get started. We're going to cover 7 different topics today. They're going to range from talking about the economy, where we still do think that we're going to have a mild recession starting early next year. We're going to mention politics. We're going to talk about fixed income, where interest rates have continued to soar, but we think we're going to see them reverse some of that increase that we've seen. We're going to talk about equities and how earnings are really going to have to be the driver of getting the equity market going higher. And we're going to conclude talking about asset allocation. Before we actually get into our views, the one thing that experienced sailors know is that you don't sail a boat backwards, and that oftentimes the calm waters of yesterday don't necessarily last. When those sailors look forward, they use all of the tools at their disposal to try and predict the weather, the depth of the water, the tides, and the winds to be able to adeptly navigate their destination. As for the financial markets, investors can say the same. You cannot rely on the past, and you have to set your sights forward. When we look back, there's no doubt that there has been a lot of wind in the sail, and that's been pushing the economy forward. In the form of these 4 different components, obviously, low interest rates have made it easy to borrow money to help fund growth. We've had record fiscal stimulus. There's been an incredibly strong labor market, and then there's been record consumer spending when it comes to travel and leisure. But these winds are dying down, and we can no longer count on the relatively smooth sailing that we've experienced. Looking forward, we believe the trip is likely to get more challenging and choppy, and to help us navigate, we use these tools at our disposal. Those tools include for real-time economic indicators, because they give us the early warning signals if there's any changing dynamics to the economy. We look at historical analysis because that gives us a map of what we've seen in the past and whether or not it's actually relevant going forward. And then, of course, we're looking at valuations because they give us a really good perspective on the depth of performance to expect going forward. And then, obviously, we're always looking at what policymakers are doing down in Washington, whether that be Congress or the Fed. But the bottom line is that the past is of little use to us. We need to make sure that we're preparing for the winds that are blowing today. In this presentation, we lay out that path, and we expect the economy and the markets, the path the economy and the markets should take for the remainder of 2023 and into 2024. Now, looking at the economy, there does appear to be some storm clouds building on the horizon. The reason? Stimulus is fading. Think back to the presentations that we've given. We've talked about $2.1 trillion in excess savings in consumer bank accounts. We've talked about how rates were near zero, which made it very easy for businesses and consumers to get access to money. And we talked about how the Fed was buying an inordinate amount of treasuries to keep interest rates low. Looking forward, those tailwinds are gone. When you look at excess savings, at one point they were at 2.1 trillion. But as we sit here today, our economists believe that we have evaporated most of those additional savings, which you can see here. And when you look at the fixed costs that consumers have to take on right now, it continues to grow significantly. Think about the average mortgage for the average person right now, sitting at $2,250 a month. That does not include insurance. Think about the average auto loan pushing north of $700 a month, and that doesn't include insurance either. And then the average amount that most of us are paying on gas is $200 a month, albeit in the Bay Area, much more. When you add all of these things up, your mortgage, your auto loan, and gas, it's north of $3,000 per month for the average consumer. That's an increase of 78% since COVID started, and we all feel it. Like a sailboat, we can't go backwards. We have to steer that boat forward, and the contribution coming from consumers is likely to fade. Combine that with our expectation that you're going to see job growth turn negative during the first half of next year. In addition, banks are getting more stringent with lending out money to both consumers and businesses. And in many ways, that may be warranted if you look at the statistics. Right now, delinquencies are starting to rise. Credit card delinquencies now are at the highest level in more than a decade. With savings being depleted and access to credit getting more challenging, you're starting to see that impact on the consumer. Let's look at those real-time indicators. And one of our favorites is credit card spending. When you look at credit card spending over the last couple months, it's either flatlined or gone slightly negative. And that's for both discretionary spending and non-discretionary spending. When you look at the anecdotal evidence that's out there in the headlines, you're seeing a consumer demand that's starting to soften. It starts with travel. If you look at people getting on airplanes, it appears that those are starting to stall with less people actually getting on airplanes. By the way, airfare prices are down 15% year over year. And when it comes to travel and leisure, whether you're going to amusement parks, on vacations, or to a Broadway show, you're starting to see a softening of attendance. Even trips to Europe during a time where our dollar has been so favorable and strong are starting to slow as well. Then when you look at those luxury brands, the consumer is starting to weaken in those luxury brands as well. Demand is cooling as what they call revenge pleasure from 2021 and 2022 is starting to fade. In addition, these headlines don't take into account that starting in October, tens of millions of student loan borrowers are now paying somewhere between $200 to $300 per month to pay back their student loans. When we look at our survey, what we actually see is more insights into how consumer behavior is going to unfold. When we ask the question, are you going to spend more over the next 6 months than you did over the previous 6 months, only 5% of respondents said that they would spend more. What's more concerning to me is that 33% said that they're going to spend less over the next 6 months, which is an important time period because that includes the all-important holiday shopping season that's right around the corner. That point is 90% of people are either going to spend the same or less over the next 6 months, given the fact that the consumer is such a driver of the economy that could lead us into a mild recession. Now, despite the fact that many people think that the economy is too resilient and growing too fast to see a major change in growth, we think that can still take place. If you look back, history shows that clouds can come in very quickly. Just look at the last 12 recessions here on this graph. If you look at the dark blue bars, that's what growth was the quarter before we went into the recession. The average growth was plus 2.6%, so pretty healthy. Pretty robust the following quarter, those light blue bars, is when we actually went into the recession. What you see is that quarter growth fell 3.5%. That's a pretty significant change in the economy. If you look at it in total, that's a reversion of over 6%, and that turnaround can happen very quickly as a result. Our forecast that the U.S. economy will enter a mild recession in the first quarter of next year isn't really an outlier, but the point is when you look at these economic forecasts, we do expect it to be mild. And the way we defined mild is that we think that economic contraction of the economy from peak to trough is going to be about a quarter of what we usually expect. We think GDP is going to contract about 0.6%. Usually it contracts 2.5%. It's going to be short 6 months versus 10 months. And we think the number of jobs lost in totality is going to be 500,000 people versus 3.5 million typically. I don't think that you're going to see a dramatic effect on earnings growth. Now, the reason that we think it's going to be a mild recession are listed here. Number one, overall, the consumer is still in pretty good shape. We haven't seen conditions where people are getting over leveraged and they can't continue to afford what they're doing. We still have a fairly healthy job market. Remember, job numbers came out today, this morning, and they posted over 9.6 million job openings. To be exact, it was 9.55. I don't think you're going to see massive layoffs because businesses have had such a hard time finding good people. And if they do lay off people, it will likely be slow. We don't see a housing bubble. We don't see bloated inventories that's going to take quarters for retailers to go ahead and get that off of their books. I think that we're still going to see some government spending. And yes, when you look at the new budget, the growth in spending is going to be very small. But keep in mind, we still have significant packages that have been put in place that will continue to dole out money over the next several years. We do think that you're going to see we do know we've already seen rolling recessions. What I mean by that is examples like the freight industry and the retail industry have seemed like they've already been in a recession and they're starting to pull themselves out of it. But probably one of the most important dynamics that we got out of our survey was that only 12% of respondents do not expect a recession over the next 12 months, which conversely means that 88% of our respondents believe that a recession is forthcoming over the next 12 months. Why is that important to you guys? Because when almost 90% of the survey respondents said that they're expecting a recession in the next 12 months, they've already started adjusting their spending behavior. You're not going to see everybody stop spending at the same time, which can cause a more severe recession. As a result, we think the economic growth next year will be small, but a positive small at 0.4% as noted here. Now, there are two major risks that we need to monitor. The first is monetary policy led by Fed Chairman Powell. Our base case is that the Fed is close to being done because their battle with inflation appears to be coming to an end. Why? Well, when you look at inflation, particularly when you have a recession, inflation tends to go down during a recession. If you look at this attribution, when you get into a recession, these black bars, which is attributed to the demand of goods, is usually not as great. So that tends to cause prices to go down. When you go into a recession, which are these gray shaded areas, the demand part of inflation starts to go lower. In fact, historically, when you go into a recession, inflation comes down by more than 1.5%. Getting more specific to inflation, there's really two dynamics to inflation. There's goods and services. When you look specifically at goods, we think that the trend of goods pricing will come down. One of the reasons why we believe that is because if you look at this Adobe Digital Price Index, it's probably the best indicator of the price of goods that are being sold online. One of the main reasons this will likely continue, is that if you're going to see high promotional activity going forward online, you're going to continue to see goods and services move. At least in the near term, we'll likely see this trend continue downward as those promotional deals continue online. The other side of the inflation equation is shelter or services, which is for the most part dominated by shelter or rental prices. When you look at this particular chart, this is the official statistics of the government. When you look at rents, it shows that rental prices have just started to move lower recently. We think there's a lag with this number, and we tend to like to look at real-time indicators. We like to look at leases that are being signed today, and we can find that activity on things like rent.com or Zillow. The reason that I bring this up is the other side of the equation. The reason that I bring this up is because if you substitute the data that I just shared with you from the government with the data from Zillow or rent.com, you would see a totally different story. In fact, you would see that if you incorporated historically the rent.com numbers, inflation would already be close to the Fed's target, around 2%. The official statistics are lagging, but if you're looking at what's happening with rent.com or Zillow.com, we think you're going to see those shelter prices come down fairly dramatically as we go into next year. The other reason why we think inflation is going to continue to come down is because of time. Think back to last year. We had a period of time last year where we saw highly elevated inflationary numbers coming in. The way we look at inflation is on a 12-month rolling basis. So as those high numbers of inflation start to roll off, the numbers get replaced with the new lower numbers, which continue to be lower. You're going to see this trend in inflation continue to move in a downward trajectory. Now, when it comes to the Fed, there's a lot of people out there in the market that believe United States economy is no longer interest rate sensitive. However, we disagree with that. This economy is still interest rate sensitive. The reason it's been less sensitive thus far with the Fed's raising rates is because all the money that's been floating around in people's bank accounts, that $2.1 trillion that we talked about at the beginning of our presentation. It was easy to get money. It's been a buffer. But the point of all is that it's now evaporated. So now we're going to have to see the impact of those higher rates. When you look at revolving credit, not only has it continued to move higher, but look at the rate that you're paying on your credit cards, over 20%. When it comes to housing and auto affordability, because those prices have not necessarily come down, but interest rates have gone higher, the affordability of those things is at the lowest levels that we've seen in decades. This is important for the economy because if there's less autos being sold and less homes being sold, that reduces the activity of the economy and it brings down the growth rate of the economy. I think the housing and auto market is a big example of lagged impact of interest rates. How many people out there have you heard say, I'm going to buy a house when interest rates come down, or I'm going to buy a car when interest rates come down? They haven't gone down, and now I think they've gone too high for those people to come back into the market. You'll start to see those lagged effects where they are no longer going to be buying that car or home. And then in the form of government perspective, you're saying that our interest expense that we're paying is approaching $1 trillion. Now that is more than what the US government pays on defense. The problem with that is that as we continue to issue more and more debt, it's going to have a much higher interest expense associated with it. Not only is the new debt going to have a higher interest expense, but so is a lot of debt that's coming due. That's going to have to be refinanced. And as this number goes higher, that's going to take up more and more of the ability for the government to spend. It's going to crowd out the ability to spend on other initiatives like healthcare or education. The bottom line of this chart overall is that higher interest payments by consumers, businesses, and government divert spending away from those things that actually drive economic growth. As a result, we think the Fed is likely to raise interest rates one more time this year, although today was not the day. The Fed did have a meeting today and decided to hold off. Now, we don't think that they should raise rates anymore, but they're likely to raise rates one more time. One thing the Fed has been very good at is that they've done what they've told us they're going to do. They did have one more interest rate hike baked into their forecast. If they do raise rates one more time, it will occur in December. However, we do believe by the time we get to mid next year, so mid 2024, we think the Fed will start to cut interest rates. By the way, that's par for the course. December to July is 7 months. 7 months is exactly the average amount of time historically between the last Fed rate hike and the first Fed rate cut. Now, the other risk that we need to monitor for the economy is the price of oil. The price of oil has been coming down, but of late it has started to reverse higher. The reason that's important is because when oil prices move higher, it tends to dampen consumer sentiment. When that occurs, that tends to depress consumer spending. The other reason why it's important is because of energy prices have a big impact on inflation. If you look at the top, this is where inflation has been. The blue component of the proportion of inflation that has been dictated or driven by energy and commodity prices. As those prices were going higher, that had a big impact on inflation. And where that was going, where those prices were falling, they had a big impact on the decline that we have been seeing with inflation. Recently, energy and commodity prices actually have been a detraction from inflation. But if energy were to once again start to move higher, it could potentially lead to elevated levels of inflation. This could cause the Fed to have to lift interest rates more. And because I believe the economy is still interest rate sensitive, that could potentially cause a more severe recession. Again, that's not our base case, but that's a risk that we're watching. In addition, this impact on oil also leads me to how we're viewing the horrific and tragic events that are taking place over in Israel. There's three dynamics that we look when we're looking for our outlook. The first is, does what's happening over there directly disrupt supply chains? And our answer for that, for the most part, would be no. Second, does it lead to a significant increase in oil prices? And for the most part, we think that's no, unless the war spreads to the broader Middle East. And the third is, will this conflict lead to a major decline in either economic or earnings growth for United States companies? And right now, from our vantage point, we don't think that that's likely. So overall, despite some near-term volatility, which we definitely have seen in the markets, I don't think this situation will have a big impact on our forecast. Turning to politics, I think it's still too early to go ahead and address politics, but what I will say is that we're about a year out from the next presidential election, and we're starting to keep an eye on it. Now, turning to the fixed income market, we believe that interest rates are headed lower over the next 12 months. We've been calling for lower rates, but they continue to remain elusive and swim higher. The grind higher in interest rates over the last 2 years has been incredibly painful, with yields moving higher. Bonds in aggregate have suffered some of the steepest declines we've seen on record. Now, many people believe that this is a pretty aggressive call and that it's unlikely to happen, but we would remind investors that the market has been wrong-footed several times already this year. Markets can move very quickly, especially when you see uber pessimism. And if you look year to date, there's already been 4 times where the market's been wrong-footed. Think back to the beginning of the year. Nobody really liked the equity market. In fact, it was the first time at the beginning of this year that the equity strategists in aggregate thought that we were going to see negative performance. Fast forward, we've had double-digit positive growth performance towards the beginning of the year. Most people thought that tech stocks would have another disappointing year. Well, fast forward to where we are today, tech stocks were up over 30% in March. When you saw the financial turmoil, people soured on financial stocks. The reality is, since that, they've actually been up 6.4%. And then people failed to realize that back in June, there was a time period where very few people liked energy stocks. For that reason, many economists were forecasting oil prices to go down to $50 a barrel. Well, fast forward to today, and they've moved completely in the opposite direction. Oil's in the 80s, energy stocks are up 15% since that time period. My point of showing you these 4 incidences are that sometimes the consensus isn't necessarily correct, and that what you're seeing right now in fixed income is a lot of people suggesting that rates are going to continue to move higher. Just look at these highlights. Treasury yields aren't done rising, they're going to stay higher for longer. And when I look at the positioning within the bond market, I'm seeing some of the pessimistic positioning you've seen in history. In fact, look at the amount of people that are shorting bonds. It shows in this chart. When you quote short bonds, that means that people think that bond prices are going to go lower. Conversely, that yields are going to go higher. It's a record amount of people thinking that that's going to occur. When you see such extreme positioning, as we're seeing right now in one direction, it doesn't take much to get a shift to go in the other direction. Now, when it comes to positioning, we prefer high-quality bonds, such as treasuries, municipals, and high-quality investment-grade corporate bonds. We're starting to see bankruptcies move higher. Through the first half of this year, this dark blue shaded part of the bar is the highest number of bankruptcies that we've seen since 2010. As we project out for the remainder of this year, it's likely to be the greatest number of bankruptcies that we've seen since 2010. Similarly, you're starting to see defaults pile up, and it's our expectation that this could be the largest annual amount on record by the end of this year when you talk about high yield companies in the bond sector. They tend to need access to money to fund their operations. And what happens when interest rates move higher is it gets more and more expensive to fund those operations. Number one, they issue new debt, which gets more expensive. And number two, look at this wall of maturity that's coming due in this graph. Fast forward and they have to refinance that existing debt, it's going to lead to more high interest expenses. When we look at the index, over 80% of the companies in the high yield index currently have a coupon that is lower than the current market rate. That's because the Feds have been raising rates for the last year and a half, which means they have to come to market. It's going to continually increase those interest expenses. And these are oftentimes companies that can't afford the increased interest expense. It's going to get expensive very quickly for these companies, and you could see more defaults forthcoming. That's a key reason we remain more cautious on the high yield sector, staying safe in treasuries, municipals, and then good debt. Turning on the equity market, we're using Popeye the Sailor as our analogy here to equate his secret strengthener, which is spinach, to the earnings environment. Now, before I get to the actual outlook, I did want to address the recent volatility that we've seen in the market, because in my point of view, I don't think it's unusual that the probability of a 5% or more pullback was building. It was building for two reasons. Number one, we'd gotten above our 4,400 target for the S&P 500 by the end of the year. And number two, it was time, guys. If you think back, we talked about the fact that we only had one 5% or more pullback that happened in March. Historically, in a given year, you have 3 to 4 5% or more pullbacks. We think you're going to continue to see some volatility over the next month or so. The other thing that's important to understand about this chart is that the equity market does not move in a straight line. In fact, oftentimes it tends to tack back and forth depending on winds and headlines before it ultimately does move higher. Now, what has driven the equity market year to date? Year to date, it's really been PE, price to earnings expansion, which is a form of market sentiment. When you look at this chart here, this light blue, that's the portion of the return this year that's been attributed to earnings growth. We've had very little. What has led the run up in equity prices has been the dark blue, which is the PE expansion and the PE multiple for the S&P 500, which has expanded 17.5 times earnings to well north of 19 times earnings. Remember, coming into this year, people were worried about the Fed. Well, the Fed had gotten less aggressive. We're not seeing the increasing rates by 0.5% at every meeting. In fact, we think we're closer to the end of the tightening cycle. You've seen moderating inflation, better than expected, because remember, at the beginning of the year, many people thought that we were going to have a recession in that first or second quarter. Well, clearly the economy has been stronger than that. We have had improved sentiment more recently by analysts upgrading their forecast for the S&P 500. It's been a better environment for stocks. Now, PE expansion is very consistent with history. Remember that we just hit the 1-year mark of this bull market on October 12th, so in the last few weeks. It's been 1 year since we hit our lows of 2022. What happens during the first year of bull market history historically is that PE multiples tend to drive performance with very little coming from earnings. In the second year, you get very little help from the PE expansion, and you need earnings to drive that growth to get the markets higher. Unfortunately, we've seen some headwinds when it comes to earnings over the next 12 months. And there's really a couple things to look at. Number one, as I mentioned, I think the economy may struggle, and if you look, there's been a very strong relationship between sales growth and top line revenue. As I mentioned, we think that real growth will be at 0.4%, nominal growth around 3% or so, and then 3% top line revenue is still pretty weak when it comes to the equity market. So we have a weak top line growth forthcoming. Plus, when you go into a recession, which are these gray shaded areas, you tend to see margins go lower, and that makes sense because you don't have the ability to see this top line able to generate revenues to offset expenses. With margins coming down quite a bit, revenue not being as healthy, you're likely to see a challenging environment. Combine that with the fact that the dollar continues to strengthen, that hurts the valuation of revenue overseas. For the S&P 500, we get about 40% of our revenues overseas. And then higher energy prices could continue to hamper overall expenses for companies. This leads to some of those headwinds that we've been talking about this year. The other two headwinds in front of the market are the fact that corporations are buying back their own stock. As earnings start to get more challenged, you see that they've been doing less and less of that, which this trend is likely to continue. And then from the valuation perspective, the bond market is really giving the equity market some serious challenges. Why? Because higher rates have become much more attractive. Back in 2020, you saw the dividend yield was approximately 1% higher than the 10-year Treasury yield. Today, the dividend yield is approximately 3% lower than the 10-year Treasury yield. Put another way, back in 2020, 70% of the S&P 500 companies have a dividend greater than the 10-year Treasury yield. Today, less than 10% of those S&P 500 companies have a dividend yield greater than the 10-year Treasury. In many ways, the fixed income market has become a big challenge to equity markets, which is another reason for our subdued outlook when it comes to the equity market. We still reiterate by the end of this year, we think we'll be at around 4,400 and the next 12-month time period at 4,650. Now, despite our near-term caution, we think it's important to recognize the fact that longer term, we are still very optimistic on the equity market. These are the reasons when you look at those factors, I think it's important to realize that the Fed is likely done with its tightening cycle and they're going to start cutting. Historically, that tends to be positive for the equity market. Interest rates are more likely to move lower. That'll start to reduce some of the attractiveness of fixed income, and markets typically rally following a recession. If you look right here, historically, the market tends to bottom 4 to 6 months before the recession ends. Economists think that the recession will last about 6%, ending sometime mid next year. So at some point in the first quarter of next year, we could see the equity markets already start to move higher. That's one of the reasons why I don't see a significant decline in equity markets moving forward. Third, it's still early in this bull market cycle. Historically, bull markets last 6 years. We celebrated our first anniversary of this bull market back on October 12th. And then fourth, there's still plenty of cash on the sidelines. There's $5.5 trillion sitting in money market accounts out there. And if just a portion of that starts to find its way into the equity markets, it really could serve as a tailwind. Overall, there's still subdued investor sentiment. I really get worried about the equity market when people are very optimistic, and I don't see that happening in the market right now. Now, turning to international markets, we continue to favor U.S. equity market over other developed markets. We've talked about it in the past, and the United States economy and the United States companies are the most resilient. They tend to be the most dynamic, and they tend to be able to navigate more challenging periods of time. Given the fact that we think you're going to see a recession, not only here, but abroad as well, that means the United States should recover the fastest. Historically, if you go back to 2019 and you project to include 2024, U.S. companies tend to have the best earnings growth. You want to be where you have the most consistent outperformers when it comes to earnings growth. So that's why we continue to find ourselves liking the U.S. equity market over other international developed markets, which is in line with our current investment strategy. Now, there are still some opportunities, we believe, in the emerging markets factor. And there's 5 reasons. A lot of them here are duplicative of why we like the U.S. equity market. When you look at macro factors, though, excuse me, historically, emerging markets do well after the final federal funds rate hike. When you see falling interest rates, falling inflation, that's a big story that's unfolding in the emerging market sector. Inflation kind of started first, but it's also where you're seeing some of the biggest declines so far. Because of those declines in inflation, you're actually seeing several emerging market central banks already cutting interest rates. When it comes to some respective areas to look at, India and Mexico are benefiting from what we're calling friends shoring. This is where a lot of companies are moving some of their manufacturing capabilities out of China to both India and Mexico, which will help those specific countries. Look at these headlines here, guys. They've already been factored into the prices over in China, and you can't keep sending the stock market down there. There's been some potential positive catalyst, for example, and it looks as if President Xi is going to meet President Biden in November in San Francisco at the APEC summit. That could be a net positive when it comes to tensions between the United States and China. Last week, they had Golden Week, which is where there was a lot of travel and tourism taking place all over China. And while it may have come in slightly below what they were forecasting, the reality is that it was back to pre-COVID levels, which is fantastic. We see some of the green shoots starting to unfold in China, and they still have the ability to have both monetary and fiscal stimulus over there. So that's one of the reasons why we continue to like some of the emerging markets for long-term investors. For asset allocation, we turn to the Buffett brothers. And no, they're not related, guys, other than the fact that they're both good businessmen. When it comes to Warren Buffett, he oftentimes says, be fearful when others are greedy and greedy when others are fearful. I think this is sage advice because I showed you example after example of how panic selling can oftentimes leave your portfolio shipwrecked. In this chart, we look at fund flows. We've gone back to 2010. We've looked at months where money has come out of the market, where people were panicked, so they're pulling money out. And then we've looked at months where people were putting money into the equity market, which is more of the optimistic type of sentiment for the market. What's interesting to note is that when people were pouring money out of the market, if you fast forward 3 months later, the equity market was up almost 5%. In those months where people were more optimistic and continued to put money into the equity market, 3 months later, it was only up 2%. Getting in when people were coming out of equity markets has historically shown more robust performance. Second, we went back to 2010 and we noted with a star on this chart when the market was in panic mode. When CNBC had a special show at night called Markets in Turmoil over this time period. There have been 106 of these shows, and 105 of those, the market has been positive 1 year later. 99% of the time, and on average, 12 months later, the market has been up on average 38%. So when you see these shows in the press, don't panic because they tend to be a contrarian indicator that better performance is likely forthcoming. Remember, I always say that the media always has an apocalypse du jour for you to feed on so you come back the next day. Take that and do with it as you please. But remember that out of those times, 99% of the time, the market has been positive 1 year later. Please remember here, guys, we're getting ready to close up. We're not in the business of predictions. We like to use this data to help us see where the ship is sailing and to better prepare our clients for their futures. If you have specific questions, please feel free to reach out to me. Send me an email, give me a call. I appreciate your time this evening. Thank you for tuning in. Take care, and I'll see you next quarter.